Hello everyone, it is Sterling here from Day Trading Forex Live, and I'm back for another video. What we're going to cover here in this live stream is going to be something that, regardless of the strategy that you use right now, regardless of even the market that you trade in, whether it's a technical strategy, a fundamental based strategy, whether it's based on indicators, I don't care what it is, there's one thing that's going to affect every one of you, and that's position sizing. Regardless of the market, the strategy, and all those other aspects we went through, you're going to have to deal with position sizing. You're going to need to know what proper position sizing is, because if you're going to make it as a profitable trader, if you're going to make it as a full-time trader, obviously position sizing is a massive chunk of that. And it's a question I get all the time. I get people emailing me and asking questions on position sizing almost daily. I mean, we get probably 30, 40 emails a day, but at least one of them is probably going to be on position sizing, if not more, on a daily basis. So I know it's an important topic, and I kind of have a unique view on position sizing. It's probably not going to be something you've heard before. I've never heard somebody talk about it. It's not complicated, very simple, like everything else I do. And maybe that's one of the reasons why people haven't talked about or don't talk about this kind of just simple idea, because there's always the complex idea is thought of as being better, is kind of how I view it. So what size should you use? Well, when it comes to position sizing, so we'll just write this out here. And by the way, guys, feel free to leave a comment below. Let me know what your guys' thoughts are on position sizing, what you think about what we're going to cover here, and any other questions you have. I'll look over at the questions here in a minute. But when it comes to position sizing, I have one very simple belief, and this kind of maybe starts with the question of whether you should do live trading or demo. What is the benefit and the difference between those? I used to really value the demo aspect first. I used to push that a bit more, but there's a reason. The reason I went to the live goes right in with the position sizing we're going to talk about. And the reason why I recommend live, if you have the ability to control yourself, if you don't have the ability to use a set leverage, and you constantly find yourself over leveraging, over trading, mainly over leveraging, that's what we're talking about, then that's a little different discussion. And quite honestly, you're going to have to get that under control. There's not an easy answer to that. You're the only one pressing buy or sell. So if you can't force yourself to stick to this position sizing, it's only going to benefit you at the rate at which you apply it. So I recommend live with this one caveat and this one position sizing, which is the smallest size you can use. I highly recommend 1 micro per trade, right? So nothing complicated about this. I'm going to walk through why this is based on 15 years trading experience, guys, and 11 of those years educating traders. This has been what I find to be the best, and there's an entire reason why that is. But what this does, number one, is it gets you in a live format. If you can force yourself to stick with the smallest size, some of you guys trade, there's smaller sizes than micro, nano lots, and different options as far as that goes. But most brokers are going to give you the option of a micro lot. You're going to have that option. And what that does, that significantly reduces the risk you have, because when it comes to learning to trade, there's one thing we all know that is certain. Whether you go this route or this route, when you're learning, you're going to lose. You're going to lose money while you're learning to trade. I know that's maybe not a popular opinion, but it's a fact. You're going to lose money as you learn to trade. So the goal is to do two things. One, not psychologically damage yourself so much that profitable trading becomes all but impossible because of all the mental baggage you have. That's a big aspect of it. But number two, just staying in the game long enough to get the experience. It takes time to deal with the emotions that come up, the fear, the greed, the desire to take profit when it hit 20 pips after you just took a loss and you want to just lock in some profit. All that stuff takes time to learn, and you need to lose. You need to blow up a few accounts. But once you're really at the point where you're dedicated to this and you're approaching it with a systematic approach, you have a very clear strategy, you have a written trading plan as we talked about in previous videos, and you're following it and you're implementing it, you need to get some metrics. You need to get some metrics as to whether you're profitable. And starting with a micro lot is huge. It's going to limit your losses. It's also going to give you the ability to trade in the most low stress and live environment that you can. There's one universal truth about position sizing. There's another universal truth, I guess, and that is when it comes to position sizing, the larger size you are using, the more difficult trading becomes. If I were to give somebody a position that is based on one micro lot and that's the position they're trading in their own account, and then I were to put them in a position that was max leverage on their account, what one of those positions is going to be producing the stress? You know, where are you going to be feeling the stress from? You're going to feel it from the larger position. So number one, it's easier, or number one really, is that you're going to lose some money. It takes time to practice. You need to stay in the game. This is what's going to keep you in the game as long as possible while giving you the experience you need in the live account. You need live account experience. And in my time as an educator and my time as a trader, I've gone more from the demo to live because of just what I've seen, how I've seen it help traders progress that were stuck on demo for so long because they thought they had to be profitable. But really what it was is they just needed the responsibility and the weight of live to get them to stay disciplined to stick to the micro lot. So that might be something you're struggling with. And if you have the ability to throw a couple $100 in a trading account and just trade with a micro lot, that would be my recommendation. It's going to allow you to stay in the game longer. It's also going to put you in the position where you have the least amount of stress possible in a live environment. That is critical because if you can't make money, like we just covered, if we can't make money with one micro, I can promise that if you move this over here, and you were to trade with, well, I'm not going to write and confuse actually, you were to trade this with one mini, or you were to put one standard in, trading doesn't become easier the larger you go. So why not prove profitability to yourself with that? Prove the profitability, lay the foundation. If you imagine you have 2-3 months of profitable trading with one micro lot, every trade sticking to your trading plan, imagine what type of foundation that would give for you to go, okay, you know what? I'm going to bump this up to one mini lot because that's closer to an average risk per trade on your account value, whatever that might be, which we'll also get into that as well, larger position sizing once you're profitable with this. Everything hinges from this though, guys. If you can't turn a profit, and this is the question you got to ask yourself, maybe you can come up with a logical answer. Write it in the comments. If there's a logical answer, maybe I'm missing. After 11 years of educating traders, 15 years of trading on my own, maybe there's something I'm missing about trading larger size that makes trading easier. So you can sense the sarcasm here, but I think we're all on the same page. It's logical to say that risking a smaller amount of money, you're going to have less stress, make decisions that are much less emotional, and it's going to be easier to follow a plan. So build the foundation, guys, and build it on the smallest size possible. It'll keep you in the game longer. It's easier to trade that size and allow you to build a foundation in your trading. And we're also going to talk about when you go to the larger size. So when do you go to the larger size? Well, let me see if there's any questions here. See if there's anything you guys have. If there are any comments, feel free to write them in as we go. But I touched on this briefly in a video I did. I was in my truck and I was talking about the 20 trade challenge. But basically what that talks about, and it all relates to this, and that's what we'll kind of briefly touch on next. But that 20 trade challenge, what that said is, so we'll just write that out. Well, let's see here, 20 trade. Let's do that. 20 trade challenge. There you go. A little bit easier to write out. So you had the 20 trade challenge. What is the 20 trade challenge? The 20 trade challenge is very simple. Go into your account history. I don't care what broker you trade with. Go into your account history. And maybe I'll preface this by saying the 20 trade challenge requires that you're trading a strategy. If you are willy-nilly, buy and sell gunslinger, and you have no reason why you're placing that trade, you know why you're not profitable. You know why you're not profitable because your actions aren't consistent, so your results aren't going to be consistent. They'll be consistently negative, yeah, but you're not going to see any consistent profit. So number one is you have to have a trade plan. You have to have some type of strategy that has specific guidelines and rules for this to work. Otherwise, what do you judge against? You know, you can't, how do you say that's a good trade or that's a bad trade? If you don't have anything to judge it against, then you're kind of screwed there. So you want to have, number one, some type of trading plan that lays out your strategy. It details all those aspects so that you can judge, you know, whether or not that was a good trade, whether or not that trade satisfied the rule set that you follow. So that's number one, is having that trading plan in place. But then number two, and really this is a very simple process that will kind of determine whether or not you're ready to maybe start trading some larger size or even consider it. And that is, go through your history. So you're going to pull up your history of trades. If you're in MT4, I have an article on the site that walks through how you do that. You go into your terminal, then you go down to your orders, you right click in the orders section. You go up to, I think it says something like show last 3 months or something like that. Or you can show a custom period. But look at your last 3 to 6 months of trades. Is there anywhere in that 3 to 6 months worth of trades where you took 20 trades in a row, and hell, you know, maybe if you're new, let's just say even 10 trades in a row, call it the 10 trade challenge. Is there anywhere in your trading record where you have 20 trades in a row that follow this? Because if you don't have 20 trades in a row that consistently follow a plan, then that points to an even bigger problem. It points to the problem that regardless of your strategy, imagine you have the most profitable strategy ever known to mankind, whatever that might be. If you place 2 trades, because every strategy, even the best strategy out there, you're going to lose money. You're going to have losing trades. You're going to have losing weeks. You might even have losing months, depending on the type of strategy and how long-term or short-term. There's one thing that's certain, though. If you can't follow that plan, if your trading looks like this, where you go, okay, win, okay, things are looking good, things are all going right, and maybe I get another win, oh man, things are looking really good, things are going uphill, I'm turning the corner, I'm not making bad decisions, you know, following the plan, it all works. But then you have this. You have a, well, let's do this here. Let's call it a loss. So you have a loss. What happens after that loss? You have your revenge trade. We'll put some abbreviations here just to kind of speed this process up. You have your revenge trade. Then maybe the person goes to the old double down. Or maybe they go to, you know, the quadruple down, or over leveraging, boredom trades, system jumping, whatever it might be. The point is, if there's not a period, and this is where you got to be brutally honest with yourself, because simply hitting X in the upper right-hand corner doesn't make what I just said untrue. Somebody exits this video because they don't like what's said subconsciously or consciously. It doesn't make what was just said not true. Logically speaking, is there any logical reason you can give to yourself that would say, you know what, I don't have to follow an exact plan. I can just do whatever I like with each trade, and it doesn't matter what I do. Is there any logical reason you can put to that? And I can't put logical reasoning to that. Where people succeed is they have a plan, they follow that plan. Where people fail is they maybe have a plan, they implement that plan until 1 or 2 things go wrong. And then I've been there. I don't say this based on anybody else's experience but my own experience. I would have win, then I'd have a loss of some kind and I would blow up. The one story I can tell you guys that sticks out in my mind like as clear as yesterday. I remember trading the pound yen. I was going over to my cousin's house. I was pretty young at this point, but I had the week before, I had taken an account from $2,000 up to $15,000. And I had a rough plan, you know, I had a rough idea of the trading strategy I would use. And it just happened to be that the week before, everything was hitting right. I mean, I was winning 80% of my trades. And the Sunday market opened and the pound yen started to tank. So I started to buy into the pound yen. And ultimately, long story short, I wiped out that $15,000 account. I wiped out that $15,000 account, took it right back to 2,000, but not even $2,000. I think I brought it down to like 1,200 before. I was just so pissed I shut off the computer. Thankfully saved myself $1,000 so I could lose that later. The point being is I've been there. Everybody listening to this video has likely been there. That's just a part of trading. I don't know if there's any way around it. But what's certain about that type of trading is that the money management you use did not matter. Doesn't matter if I had the best money management in the world. If I went win, loss, then revenge trade, overtrade, double down, which is exactly what I did on that day. If I do that, the money management I'm using doesn't mean anything because everything goes off the rails. So this is really a self-examination thing that you got to look at your own trading. You got to say, man, am I the cause of my failure? And at the end of the day, we are all the cause of our failure. We're also the cause of our success. So accepting that's critical to number one, accept, acknowledge, and kind of take in. It should be empowering. It's not the broker that's causing you to lose if you're doing this. It's not the scams that you knew were a scam before you bought into it. That's not what's keeping you from succeeding. If you look through your trading record and there's not 20 trades in a row that follow a plan, then it's solely on your shoulders. And that's not a negative thing, guys. That should be an extremely empowering thing, because if it's somebody else that's keeping you from your success, it's keeping you from where you want to be in life. None of my family supports my trading. I got to find another job to fund a trading account and to have extra money to trade with. Those are all on you. We can look at other external things, but at the end of the day, trading comes back to right here. And it's whether or not you can follow that plan. Once you can follow that plan, that's when you start looking to potentially start increasing size. Until you can follow that plan, though, there's really no point in it. Okay, let's see here. As soon as I have a loss, I instantly blame the strategy, switch strategies. Yeah, guys, I laugh. I'm not laughing at you at all. I'm just think back to when I started trading, and I think about how I used to jump strategies. I think about everything else. I blamed everything but myself. And then I'd look back at my trading plan, it'd be a total shit show. I mean, over leveraging, over trading, revenge trading, 10 different strategies, but no plan among any of them. And then I'd go, you know what? The broker slipped me 5 pips. You can't succeed in this market. It's all a scam. Well, what about the 3,000 pips that came prior to the broker slipping you 5? So we got to be honest with ourselves here. And this is this one thing right here, I haven't seen other educators talking about this extremely simple idea. And to me in trading, it's the simplest things that make the biggest improvement. I mean, it almost always is the simplest things that's going to make the biggest improvement. Okay, so we touched on 20 trade challenge, how that relates to your position sizing. If you're not there yet, that's when you should still be sticking to the 1 micro. You should still be sticking to that 1 micro, because till you can show a profit there, trading a larger size is only going to increase in faster losses. That's all there is to it. All right, I just want to take 1% per day. That's my goal, and that's a great goal. I mean, it's a great goal. It's a bit high just because you can't guarantee a profit on like one specific day. You might be able to be consistently profitable at the end of the month or at the end of the week, but guaranteeing profit on a daily basis is a bit difficult. And sometimes it can psychologically set you up to be like, man, I was down 2 days in a row. I really need to make it back. Whereas a little bit longer horizon, you might consider that. A little bit longer horizon puts you in a situation where you're psychologically in a little bit better spot. Also, you really don't, I don't think you need 1% a day. 1% a day compounded it would be ridiculous gains. So just simple terms, if you had 10K, this is the example I always use, 10K compounded at 10% per month. 10K compounded at 10% per month is just under $1 million. And I'm not saying you should expect that. I'm not saying you should expect that in any way, shape, or form. I'm quoting basic math here. So I say that because number one, I hate any type of education that pitches a get-rich-quick idea. In no way, shape, or form should you construe what I'm saying here as that type of mentality. What I'm simply trying to illustrate is that a relatively low risk per trade or low profit per month, what a lot of Forex traders would consider terrible, can grow a relatively small account in a very rapid period of time. I mean, extremely rapid. When you talk about compounding those gains month after month after month, just in 3 years, I think it's just shy of 275,000. I mean, at 275, you pull 10K or 10% on that, it's a $27,000 a month. I think most of you guys listening could live on that type of month. So it's not that far away, but it all starts right here. It all starts with this. You got to have extremely safe risk per trade. Put yourself in the lowest risk position so that you can make the most logical decisions as you're trading live. That's going to allow you to start trusting, number two, the strategy you're trading. It's going to start allowing you to trust this plan and build up the mental fortitude and give you the time to build up the mental fortitude so you're not blowing through crap tons of money getting to the point where you are profitable. Once you have 20 trades in a row that are showing you or that you followed the plan, now you can actually judge, hey, is this strategy profitable or is it not? 20 trades might not be enough, but you can't even judge whether the strategy you're trading is profitable unless you can put together at least 20 trades in a row that follow the plan exactly. So that's number two, getting to the point where you can follow that plan exactly. Once you can and you're showing some success, how do you get into growing an account? What's the point of, what should you do? What are you getting into? What type of position sizing should you use? I bring this point out because you don't need to be risking 5% per trade. You don't need to be risking 10% per trade. You also don't need to be taking 20 trades, 50 trades, 100 trades I'd say 50, 100 trades in a month, as a lot of traders do. You just don't need it. I mean, these numbers illustrate it very clearly. 10% a month compounded, 10K compounded at 10% a month grows extremely fast. It grows very rapidly. So once you're at the point where you have some success, you have that foundation built, you have maybe 2 months of profitable trading on one micro lot per trade, where do you go from there? My recommendation is that this aspect is more of an art than a science when it comes to how quickly you increase the size. But where you'd want to get up to, a safe risk per trade, I don't think, just like everything else I do, keep it simple, guys. I'm a firm believer in the basic 2% rule. 2% of your entire account value at risk for any one given trade. Now, if your type of strategy revolves around maybe basket trading, then maybe you're not going to use 2% per trade, obviously. Maybe you're using 0.5% risk per trade. But those that are taking individual trades and you don't have a ton of them running at one time, maybe you just have 1 or 2 trades running at a time, I do believe in the 2% rule. But there's one difference I have with this. Where people go wrong with the 2% rule is they go down when they have a loss. So I should say this. They drop the position size. Yeah, they drop the position sizing after they have a loss. So let's say you start out with 10 grand. So let's say you start out here with 10 grand, right? And then you lose 1,000, and so that leaves you with 9 grand at the end of the month. Where people go wrong, and this is where being profitable before you do this is important, because if you're not profitable and you do this, well, you're just back at the starting point. You're losing money at a faster rate. Go back to a micro. Once you're at this point, though, what'll happen is maybe somebody loses 10% of their account value in a given month. They have a really bad month, worse, whatever it is, week, whatever. I'm just trying to illustrate a point here. So if you drop down to, say, $9,000, where people go wrong is then they'll say, well, I'm going to risk, for next month, I'm going to risk 2% of this 9,000. And what that does is that just, it basically, to put it in simple terms, if you have a $10,000 account and it drops down to 5,000, you had a 50% loss, but you have to make a 100% gain to get that money back, to get right back to break even. So you can see that's really why in the last video, like I talked about, it's not about what you make often in trading, it's about what you don't give back. Because coming back or pulling back from that drawdown is very difficult. It's difficult psychologically. Most importantly, that's the biggest hurdle you're all going to have learning to trade Forex by far. But it's a big hurdle to come back from. So that's why I don't recommend dropping that position size, because if you're, let's say that in this case, let's say you're using 2% risk per 20 pips. Well, 100 pips would be a 10% risk then. So if you lost on 5 trades, maybe there are 20 pips risk per trade, that'd be 5 times 20, it's 100 pips. Well, if you keep your risk the same, then you have 5 winning trades, or let's say 2 winning trades on 2-to-1 reward to risk ratio. Well, you've made back the vast majority of it. So the point I guess I'm getting at, I don't know if that's coming across very clear to you guys, the message I'm trying to convey, but the main message is go off your high water mark. So if you drop down to 9 grand for the next month, use 2% risk of your high water mark. Say that's the high water mark, meaning the highest account value in your account at the end of a month. So let's say then you go to the next month, you kind of claw back, you make some nice profit, and then it comes out. And at the end of that 3rd month, you're sitting on 11 grand. Yeah, you guys can still see that. All right, so you're sitting on 11 grand at the end of that month. Well, now you have a new high water mark. So now you're going to use your 2% risk of the new figure, right? Of the $11,000 figure. So that's what I mean by high water mark. Don't adjust, or I'll say it this way, I personally would not adjust down to this number, because then it goes to what we were talking about, which is you take an account, you lose half of it, well now it takes a 100% gain to get it back. So it's the same principle there, and why I don't do that, why I go off the high water mark. Now, work into this. This 2% might be too high for you. What I would say though is 2% should never be too low for what you're using, or for your account, or I don't care what size your account is, I don't care how small it is, this number should never be too small. I don't think there's any reason to go above that risk. I don't think there's any reason to go above that risk because of this right here. You don't have to have a huge gain per month, and the larger risk you have per trade, the more difficult trading becomes, the more psychologically damaging it is when you have a loss, the more psychologically difficult it is to handle 3 winners in a row. And then you go, man, I'm the Forex god. I think I know everything. I'm going to place this buy and this sell because I know where the market's going. And then it gives you a little bit of respect, or it gives you a little bit of teaches you a little bit of respect, and you lose on both those. That's how that process works. So slow, steady, build yourselves a foundation, guys. I can promise you that slow in learning to trade is actually fast. The fastest way to learn to trade is to take it slow. I know that sounds kind of stupid, but that's always the way it is. Okay, profitable trader, nope, I think, not sure what that means, but feel free to elaborate. If you're talking about me, I do everything live, so it's kind of hard to fake live trading where I've called the trade 12 hours in advance. But most people don't know that about me, and 99% of educators talk shit, so I totally get why you have that type of mentality. Don't blame you, probably good to protect yourself. Oh, let's see, how often do you take profits? Do you leave a set amount in your account to trade to pay for yourself each month? I personally, I believe in taking money out of an account regularly. You need to make that money real to you. It's a really big issue that traders have. Like, let me phrase it this way. If, let's say you have $1,000 in your wallet, right? You have $1,000 in your wallet, and you go to the grocery store. You go to the grocery store and you're like, oh crap, I left my wallet in the cart. Somebody took my wallet. I had $1,000 in there. You don't find out who it is. That's going to bother you for a long time. I mean, it's going to bother you quite a bit. But people tend to have no problem having $1,000 in their account, and then they just massively over leverage, risk huge numbers, and blow up that $1,000 account, and then just refund it the next day. Now, you could use smaller numbers or bigger numbers, but there's a reason for that. There's a reason for that, and that is people don't view the money that's in their account the same as they view money in their wallet. That's why I say you need to make it real to you, and that's a slow process, starting with one micro, build a foundation. As you show any profit, I don't care if you're wiring out $10, send yourself the money, even if it costs you more to pull that wire than it does in fees, send yourself that money if there's a profit. I recommend sending a small portion just to psychologically make it real to you. And I know it sounds stupid, but all these little things, they add up. They add up to the big picture. Being a successful trader is not about one secret. It's about doing 100 tiny things right. It's about having the discipline to go work out in the middle of the day, because that discipline to work out in the middle of the day will transition to your discipline as a trader. Like, it's all those little tiny things that you just learn over a decade. That's one of the big reasons why I say getting an educator. I don't care if it's me. I mean, I think you guys understand that by now. I put out a lot of free content. I'm happy to help you whether you're a member or not. But get an education. Maybe you don't like the strategy I teach. Maybe you don't like my face. It doesn't matter. But find somebody you do like, and make sure, number one, they trade live. Because if somebody's not trading live, if an educator wants you to buy their service, wouldn't they trade live to show you that what they're doing works? Like, just some real basic common sense will steer you away from 99% of the scams. But find an education, because all that, all this stuff, it builds on it. It builds on itself, and it gradually curates you into a profitable trader, if you stick around long enough. Okay. Let's see what else we have here. Do I scale out? No. I'm not a big fan of scaling out of positions. To me, well, I'll say it this way. I'm much less of a fan of scaling into a position. If somebody wants to scale out, maybe there's some reasoning behind that. I personally don't. I'd rather see people in the beginning, I'd rather you go for a 2-to-1 reward to risk ratio, set the trade, and don't do anything to that trade. I'd rather you do that because it's going to teach you discipline, it's going to teach you patience, it's going to teach you the ability to follow a plan. So that's one of the big reasons why I recommend to people to set a 2-to-1 reward to risk ratio. Stops 20 pips, take profits 40. If you're doing it off percentage risk, 1% risk, 2% take profit. However you're doing that, 2-to-1 is pretty straightforward to figure out. So that's how I recommend it, but everybody's a little bit different on that, based on their own personal preference. That's just been my experience in the years I've been trading. So, all right, guys, I think I'm gonna wrap it on up on this one. I will be back. I'm trying to do these videos every other day or something like that. I'm doing a 30 Days to Better Trading series. I'll put them together, and I'll probably send it out to the email list from the Day Trading Forex Live email list once it's done and all that. But that's kind of what this series is about. But I want to keep doing them. I might even do like a Sunday, maybe a Sunday review where I cover past trades as well as give you guys future levels for that next trading day and the next trading week. Give you a little bit of a live implementation of what I do every day in the daily market preview. Because that's like I mentioned with any educator you choose, if they're not showing you the strategy works in real time, it's because it doesn't work in real time. There is no other answer to that, guys. There isn't. If an educator wants you to buy their stuff, which is why they're selling it, there's just no other reason. If they don't trade live, it's BS. So that's a huge one. But make sure you have that. I don't know where I was going with this. I'll be back with more videos. That's the point, I guess. If you like the videos, feel free to subscribe to the channel. You get updates when I'm going live. If you're on Facebook, make sure you like the video. I appreciate it. Glad you guys enjoy it. And I'll see you all back for the next one. Until then, happy trading.